Hello everyone, this is our video presentation for our tutorial task for this week. Our group members are Abhilash, Anton, myself Biju Sharon, Mariam and Siddharth. So for this week we'll be covering the CAF question. The topic is the passive equity portfolio management. In this presentation, we'll be going over 5 strategies for equity portfolio management, and we'll also cover on how to choose a good ETF, and we have applied the information that we have researched on by choosing an ETF which we think would be profitable.
Good morning, my name is Anton Kopelev and I will explain the full replication. A full replication is when an investor simply buys an ETF that holds all of the same securities as the index they wish to track. Since of ETF holds every security with the same weightings, all investors can create a nearly identical replica of the underlying index. So some examples I'll provide. For example, let's take this SPDR S&P 500 ETF, which tracks the performance of the S&P 500 index. It is very closely matched to the S&P 500, with an average price-earnings ratio of 17 and 2.2% dividend yield. It achieves the objective of full replication by holding the portfolio of the stocks in the S&P 500 index with similar weightings that correspond to the index weightings. So let's talk about which is best way for the run an index fund, full replication or optimization. The goal of the most ETF is to track the performance of an index. Fund managers have two ways, full replication and optimization. So investors want their index funds to deliver exactly the return of the indexes they track. But this is called a full replication, and it's common for funds tracking large and liquid indexes like S&P 500. But not all markets are as liquid as the companies of the S&P 500, and some indexes include thousands of constituents. For ETF, tracking indexes is in more complex or less liquid corners of the market. Full replications might not be the best way to deliver the returns of the index. Despite their negligible impact on the indexes, these securities can still be costly to acquire. Optimizing must decide if the cost of the acquiring the security overwhelms the tracking benefits of owning the security. Instead of nixing exposure altogether, optimizing managers might go so far as to identify a similar, less costly security that's highly correlated to the original. In this way, managers can make important decisions in optimizing an index. If the reduction in expenses as a percentage of the portfolio is greater than the security impact on the index, the manager will deliver the return of the index better than a full replication strategy would. Fixed income ETFs nearly all use a sampling approach because oftentimes the fund's underlying index holds thousands of bonds, many of which haven't traded in years. While sampling saves in cost, it does come with risk. The more aggressively optimization of portfolio, the most its return could vary from the index over time, either on the upside or downside. Most ETF track their indexes well, but there are dozens of examples of funds that have missed their benchmark by a few percentage points or more than a year. Thank you.
Now, moving on, we tackle sampling. Now, sampling in the benchmark index is basically a representative sample of stocks which are bought as per the rates in the index. Additionally, there are lower commissions that are derived due to these lesser stocks. And also, we need to understand that the dividends can be invested and thus it is much more easier. Also, there is a possibility that an error can occur mainly due to inaccuracy for the follow-up of the index. Additionally, we can only use a single strategy because we cannot buy a security in an index. Basically, it means that there is a collection of holdings on the hidden index, and the sampling can be used to get an overview for the index.
Core satellite investment is a strategy that aims to increase performance and diversification while keeping costs and volatility low. The strategy is based on two complementary components, the core and the satellites. This approach is mainly meant to limit on costs, volatility, and manage portfolio returns. The idea is to construct a portfolio made up of core assets that are passively managed with the intention of managing the costs as well as tracking the index. The other chunk is put in assets that are managed actively so to generate higher returns than those generated by the market. Volatility is managed by creating a core portfolio that have a low beta, while returns are managed by trying to beat the market with the minority of investments that are managed actively. In layman's terms, the core holding is a classic buy and hold combination, such as which includes world equities, ETFs, government bonds, etc. This ensures that the bulk of the investor's portfolio is broadly diversified in low cost and low correlated asset classes, which can be weighted to suit the investor's risk appetite. The satellites are specialized ETFs that allows the investor to diversify further into markets that promise higher risk adjusted returns or are uncorrelated with the core and they perform well under different market conditions. So in the picture, we can see an example of the core satellite approach. In the middle, you have the core, which includes stocks, bonds, government bonds, etc. And surrounding that are the satellites where the investor could diversify their portfolio into different segments.
There is no fixed rule on what makes a core a satellite investment. It depends on the person's goals, needs, circumstances, and the situation. The core of your portfolio should be left largely untouched and should only be acted upon when there's rebalancing to be done within the portfolio or if the goals and objectives of the investor have changed. Ideally, the core of a portfolio should be highly diversified through an index fund or an exchange trade fund, which reduces the overall market risk and significantly lower the costs incurred. So let's say an investor is looking for high return and growth through their investment. They would invest majority of their portfolio in higher risk assets like equity, and this would be their core. They would invest minority proportion of their portfolio in fixed income funds or in gold, etc. And these would be their satellite investments. On the other hand, if the investor is looking for a more defensive approach, then their core allocation will be in bonds, fixed interest funds, etc., while less in equity section of their portfolio. One of the main benefits of core portfolio is that it keeps shareholders' expenses to a minimum. As the expense ratios rise, investor returns take a hit. While small differences in expense ratio may seem minor on the surface, they can add up to big money over time. Index funds carry some of the lowest fees in the industry. So let's say if the investor chooses to invest in S&P 500, it provides easy exposure to a large number of companies and industries in one simple product. They make the ideal set it and forget it options. The satellite gives investors the opportunity to tilt their portfolio in order to take advantage of current market conditions. So if the market appears significantly overvalued and ripe for a correction, the index funds makes no adjustments. The satellite approach strategy can create opportunities to react to these events and adjust accordingly to either protect the portfolio or position it to profit. If used to make conservative changes, the satellite can potentially deliver above average returns without significantly altering the overall portfolio's risk profile.
While adding satellite investment around the core can potentially improve returns, long-term studies suggest that active managers lag the market over time. Index funds have drawn in billions of dollars in net flows because investors are realizing that trying to match an index instead of beating it has proven more successful over time. Moreover, a core satellite strategy has the potential for reduced tax efficiency. But if the investor chooses to invest a wide part of their portfolio in satellites, then they have to do a fair amount of trading in order to deliver returns. In that case, that trading tends to result in higher transaction costs and possible taxable capital gain distributions.
Dollar cost averaging refers to the practice of dividing an investment of an equity up into multiple smaller investments of equal amounts spaced out over regular intervals. The goal of dollar cost averaging is to reduce the overall impact of volatility on the price of the target asset, as the price will likely vary each time one of the periodic investment is made. The investment is not as highly subjective to volatility. Dollar cost averaging aims to avoid making mistakes of making one lump sum investments that is purely timed with regard to asset pricing. So instead of investing in a particular asset one time with single purchase at one price, with dollar cost averaging, you divide up the amount of money you would like to invest and buy small quantities of the asset over time at regular intervals. A perfect example of dollar cost averaging is its use in 401k plans, in which regular purchases are made regardless of the price of any given equity within the account. So, in a 401k plan, an employee can select a predetermined amount of their salary that they wish to invest in the mutual or index fund. So, when an employee receives their pay, the amount the employee has chosen to contribute in the 401k is invested in their investment choices. Dollar cost averaging doesn't always play out neatly. In fact, research from the Financial Planning Association and Vanguard has found that over the long term, dollar cost averaging can underperform lump sum investing. So, if you do have a large sum of money, you're better off investing it as soon as possible. Dollar cost averaging is not a solution for all investment risk. So, you will have to take on the task of identifying good investment and do the research for if you're opting for a passive dollar cost averaging approach. So, this is because if the investment the investor identifies turns out to be a bad pick, you'll only be investing steadily into a losing investment. So, for example, if you hear that XYZ company is making an acquisition that will add to its earnings, you might want to increase your exposure to the company. However, a dollar cost averaging approach does not allow for that sort of dynamic portfolio management. So the bottom line is that if you are less experienced investor and want to follow a preset approach so that you're not exposed to wild market swings, dollar cost averaging could be a good approach. Whereas if you are experienced, you might be able to get better returns by active strategizing rather than going for a dollar cost averaging approach.
Exchange traded funds or ETFs are investment instruments that issue shares which are listed on major global stock exchanges. Due to this global network, this instrument can be traded continuously in a single trading day. Similar to ordinary shares, there's a variety of ETFs such as commodity ETFs, bond ETFs, currency ETFs, etc. It's popularly used in passive portfolio strategies because it is a low cost stock and helps to cut down the overall cost of the portfolio. Besides the tax benefits and low management costs, the buyer also enjoys diversification benefits and easy procedures. An example of an ETF is S&P 500's ETF, which is currently the oldest traded ETF in the market. According to Morningstar, there are currently 2,000 ETFs listed on US exchanges and more than 5,000 around the globe. Among these, how do we know which ETF to use? There are a few criteria that need to be fulfilled by a good ETF. ETF should have a minimum level of assets, a common threshold being at least $10 million. If not, investors would lose interest. This lack of demand could lead to lower liquidity. Secondly, the higher the trading volume of an ETF, the more liquid it is. Therefore, watching the trading volume of an ETF each day is a must. Thirdly, for diversification, it is better to invest in an ETF that is based on a broad and widely followed index rather than an obscure index that has a narrow industry or geographic focus. Finally, the first ETF issuer for a particular sector gathers a large number of assets before others jump on the bandwagon. Therefore, it would be wise to look for an original ETF that has less competition and less rivalry with the other brands. Now, moving on, which would be a good ETF to choose? According to us, we think that SPDR Gold Trust would be a profitable ETF. This is because, as listed, it follows the criteria that we have listed before. Thank you for watching our presentation. We do hope you enjoyed it. Looking forward to your feedback and comments.